Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. We're looking at a pretty broad sell-off across European equity indices this morning, and no doubt the reason why is linked to that historic bailout agreement with Cyprus, with, of course, the European Union finance ministers over the weekend. Now, the portion of the deal that is most controversial, of course, is the proposed levy on bank deposits within Cyprus, about 6.75% to those up to 100,000 euros, about 9.9% for those above it. Now, at least a third, by some estimates, of the Cyprus bank deposits come from overseas, so there has been concern for many years that the size of the Cypriot banking sector, which is about 80% of GDP, has just become too big and too unwieldy to manage, and therefore creates risk for the Cypriot economy that could, of course, spill over into the Eurozone. So the unprecedented step taken by Eurozone finance ministers to tax the deposits is being described by analysts and investors as unique, and to this time and to this day hasn't really spilled over into the broader European Union. That's a good thing. There's many risks that remain, including the fact that the Cypriot parliament may not agree to these terms when it votes a little bit later today. The president really only has 20 seats in the 56-seat chamber. He's going to need 9 political rivals on side in order to get that passed, and at present that doesn't look like it's going to happen. So we're going to have to watch that with interest. At the moment, we're seeing stocks fall, FTSE 100 down about 0.7%, similar percentage declines for the major bourses around the region. Banks taking the bulk of the hit. The assumption, of course, from investors being that maybe depositors will begin to withdraw some of the cash from Eurozone banks as a result of what has been agreed at the weekend. But analysts say that's very unlikely, and that the unique circumstances in Cyprus probably mean that this is indeed the one-off the Eurozone finance ministers say that it is. The one wild card in all this will be, of course, Russia. Now, a great portion of the bank deposits in Cyprus are said to have first originated in Russia. Russia has a bilateral €2.5 billion loan with Cyprus at present that some people feel might be extended and the terms might be eased. But that may become increasingly unlikely if, of course, Russian depositors are going to end up paying the bulk of this new deposit levy. So there's everything to play for in the coming days and probably weeks before we get a true understanding of exactly where this money is going to come from and how this bailout is going to be managed. We're going to have to watch that with great interest. One other stock worth watching today, Marks & Spencer, had the biggest jump in more than 4 years. Weekend press reports of a potential bid by the Qatar Investment Authority, the sovereign wealth arm of the Gulf state government. That was rejected, or I shouldn't say rejected, at least reports of its rejection were published earlier this morning by Reuters. So what we saw was Marks & Spencer up about 9% and then pared that gain back to about 4% once the Reuters story seemed to pour cold water on the assumption of an imminent deal. You can check that story out and a whole lot more on the IB Times economy page. We'll see you tomorrow.